is the PI of this project, and he is professor and head of the Department of Agribusiness Economics and Policies. Dr. Pundir,
Yes.
there is Dr. Mr. Chandrasekhar, sir.
Yes, yes, Dr. Sunmugam, good morning.
Good morning.
This is R.S. Pundir. Sir,
Yes,
welcome you,
course,
sir. And Mr. Chandrasekhar, we are here to listen both of you today. And it's a very good response from the audience. And we are looking very keenly to listen to both of you. Please go ahead. Ritamra, please, over to you.
Yes, sir. Yeah.
Thank you.
So shall we go live, please? Good morning, everyone. I welcome all of you to the second day of the webinar on Farmers Producers Organization and Commodity Markets. Today in this session, which is session 3 of the webinar for these 2 days, we have two very eminent speakers. And the first one is Dr. V. Shanmugam, who is commodities expert and had been associated with the Multi-Commodity Exchange of India. And we have Mr. Chandrasekhar, who is for a long time, you would all have seen his columns and analysis in the Hindu Business Line. I would be introducing more of them to you later, but let me take first Dr. Shanmugam, sir. And Dr. Shanmugam, sir, has actually, as I said, that he completed his doctoral program with Indian Agricultural Research Institute, New Delhi, and worked as an agricultural specialist with the United States Department of Agriculture based out of the US Embassy in New Delhi. At USDA, he had been an authority on various agricultural crops production, trade policy, marketing, value chain, and processing. He has been instrumental in conducting various market research studies and reports. At the MCX, he has served twice as chief economist previously and as head of the research and index administration. He had led various research and advocacy activities, which led to India's commodity development markets and their use by stakeholders. He has been a thought leader in the area of agricultural policies, processing, and marketing. He has been a columnist on various leading economic financial daily newspapers of India in the past. It's been such a pleasure to see you, sir, and like getting you introduced to the audience. Dear audience, sir would be speaking on empowering farmers through collectives, leveraging reform measures. Over to you, Shanmugam, sir.
Thank you, Dr. Ritamra, and thank you, Dr. Pundir. Thanks for inviting me for sharing my views on FPOs and connecting them to commodity derivatives, and then how the current reform measures are going to help them to double the farmers' income and everything actually. So so it's a wonderful opportunity for me basically. And I have a quick presentation. In fact, the thought about FPO had started with us, long back in the sense that, we'd been struggling as commodity exchanges, how to get the farmers into the markets. And, there are a lot of constraints in getting farmers into the markets. And, farmers don't understand the markets. Farmers don't have the wherewithal to participate in the markets and things like that, actually. So we have kind of maybe whatever the thoughts which may be there in the ecosystem, but we have kind of sown the seed. I'm sure Ritamra must be remembering the experiment that we have done in Surendranagar in Gujarat, actually. So it was a wonderful opportunity for us to learn, what are the problems that, the FPOs would be facing if they have to, the farmers would be facing if they have to participate in the markets directly. And, typically, a farmer situation is today, is a situation that is, for him basically to face the markets actually. So be it a commodity derivative market, be it the farmer markets where he has to reach out to the final ground level consumer, he will have the same kind of challenges that he may have in the he will have in the commodity derivative market. So quickly, let me go through that presentation which I have put across for you, and then we'll come to the challenges for the FPOs, how we can increase their participation and things like that actually, and then we can move on. So that's how I'm planning to move across actually. Ritamra, if I have to make the presentation, how do I do that?
Sir, so just open that file and share a screen.
Okay. Am I, is the screen visible?
No, not yet.
May I say something?
Yes, sir.
Yes, sir, please.
Shanmugam, take it on your desktop, open it, then come back to this screen, click screen sharing. You'll have participant chat, share screen, record, all that. But first take it to your desktop. That is important.
Is that visible now?
No, not yet. Open our PowerPoint slide. Yes.
Is that?
Yes. And
yes,
now,
thank you.
yeah, put it, yes, very much visible, sir.
Okay. So I have a small presentation here. So this was a, an experiment which came in because farmers wanted to, the NGOs wanted to, take the farmers, walk the farmers through the experience of participating in the markets and things like that. Actually, basically the, the Surendra Nagar and Rajkot belt is, pretty rich in cotton, groundnut, and, those kind of crops actually. So we said yes, because at that point in time when I was in the exchange, we've been trading kapas, which is the raw cotton which the farmers produce at the end of the day, and how we can stabilize their income and how we can educate them on the nuances of the market and its functioning and things like that actually. So to introduce that, they invited the exchange and and they agreed to do whatever it takes to take the farmers to the commodity derivative market. So that's the start of the entire experimentation actually. So the rationale is pretty straightforward, which is to make them understand the efficacy of commodity futures trading for price hedging actually. So that's pretty straightforward. What we did, the NGO had already selected about 67 cotton growers, and we had actually set up the process by which we can develop this capacity among the farmers, or the aggregation of the farmers actually. So we had the challenge of getting these 67 farmers into a particular group, which actually was done by this ground level NGO, which is called Sajjata Sangh. And it was led by the famous NGO in based out of Ahmedabad, which is Aga Khan Rural Support Program, India. And we went on as an exchange platform, and the Farmers Federation was a link between the AKRSP broker and the Sajjata Sangh actually. So we developed a kind of a Farmers Federation, and that came in as a link actually. And we have appointed a broker as well for the entire experimentation, and started the awareness process actually. And Cardinal Edge is a market aware participant who is aware how the market functions and things like that, and he can connect the exchange in terms of what should be the steps in creating awareness among the farmers, and how do we do the hedging, how to close the hedge positions which are being created and things like that actually. So that's the entire the setup that we had come up with. And the key activities which started up immediately was access to market information. So we have to tell the farmers that your prices are changing not only day to day, your prices are changing minute to minute, because there are a futures market which are discovering prices in the kapas, on a minute to minute basis, or maybe when the liquidity goes up, it is a second to second basis and things like that. So you have to face one price, because you have a one cost of producing that crop. But if you know what is the price of that crop, then what is the profit of cultivating that particular crop actually. So we had to start with what is price stability, why should you hedge your price exposures and things like that actually. And we did that awareness creation. We also did the awareness creation in terms of training and training into commodities, commodity derivative markets, how to participate in the commodity derivative markets and things like that actually. And we did the formation of linkages with professional service providers and institutions actually. And adoption or trial of of price hedging also was done by the broker and the professional service providers over a period in time. When it came into when the decision was taken and the price was agreed upon between the farmers and the Farmers Federation and the Farmers Federation in turn told about how should we what is the price at which we can go about, and how do we how do we do that. So in terms of the project operational activity, we had identified the CAAST futures. It was like 5 villages and 67 farmers were selected actually, and one representative was chosen from each village actually to take up the knowledge about the commodity derivatives over to the farmers, arrange the programs for information, so information sharing and things like that actually. And as a first step, we had started displaying the market information in a public area. So obviously we are not going to have a display board actually, because every 5 of these villages may not even have internet connectivity. So we will not be able to display it online on the this one. So what we used to do is we used to send our prices, daily end of the day prices, to AKRSP. AKRSP reaches it out through the Sajjata Sangh into the Farmers Federation, and the leader of the Farmers Federation kind of displayed it on a black and white board in the public area. So along with that, what we also innovationally or ideally what logically we have done is also that we have spread the information about the awareness about the fundamentals of cotton prices actually. So what is the supply in the US, whether the imports and exports of cotton is allowed in the country or not, and things like that actually, and what's going on in China, what's going on in the US. US is the largest cotton producers in the country. So what is going on in US and things like that actually. And then we did the broker appointment at that particular point in time. So at the top of the entire arrangement was this AKRSP and the broker and the cardinal edge. That's the top of the entire arrangement, and they connected with the Farmers Federation, which is like a kind of an informal aggregation of the farmers actually. And then that Farmers Federation had all the farmers which are into it, which is like a representative of village 1, village 2, and village 3 actually. So they all formed a Farmers Federation, and then they kind of told what is the decision which needs to be taken. That's the way that the aggregation or the kind of an informal FPO started functioning in terms of enabling farmers to participate in the markets actually. So we taught the farmers, we took the prices at which it can be traded and things like that actually. And mind it, we still took cotton because that's the most relevant crop, and we enabled them to participate. And one of the reasons why you see these different prices at which the cotton sell positions have been sold out is cotton is not that liquid contract actually. So if you go into the market and sell a 10 ton or 10 lots or 15 lots, it doesn't get executed at that price actually. But you need to wait for the right price, you need to average the prices. So that needs some kind of an management capability. How would you execute these positions in the markets actually? So that needs a specific professional capacity in which this can be done. So the average price that was expected by the farmers was around 470 rupees per quintal, and the positions were set up and sold off starting from 453, went off up to 493. The prices were jolly well increasing at that particular point in time actually. And come February, there was this news item that China has been increasingly importing cotton, more than enough what it was importing in the past and things like that actually. So that made the prices go awry. And at the end of the day, on the right side, the buy positions that you are seeing is the price at which they've sold. On an average, they've sold at 495. So end of the day, what you need to also understand is the price at which it was sold was low. On an average, it was 471. And on an average, these was bought up at 495. So it's a net to net loss to the farmers. So I have sold my quintal of cotton at 471 and I have bought it back at 495. So that's approximately about 24 rupees per quintal actually. So 24 rupees per quintal into 26 into the lot size actually. So net to net about, it was a mark to market margin of 1,23,480 rupees actually. So that's the price. That's the price that the farmers had to pay in order for them to understand what cotton hedging is all about actually. So so to say that it is not that the farmers haven't got the prices. Farmers have got the prices because they didn't ever deliver it on the exchange at all. Actually, what they did was they have delivered it on the the spot markets, because the spot markets were trading cotton at 490, 95 and things like that. And they sold it on the exchange at, on an average 470. No farmer would agree to sell it on the, exchange, because the prices are so low actually. So that is the, main crux that we need to understand beyond, the technicalities associated with participating on the exchange. So it was about ₹1,00,000. And what we did, as Dr. Ritamra, that you would be knowing or remembering, is that NABARD was, kind enough to fund this project actually. So we can kind of give you a seed fund of, ₹1,00,000, because, these farmers would need margin to be paid, and farmers don't understand putting in money to sell a crop. Actually, what they always understand is when they sell a crop, they need to get the money in hand actually. So it's as simple as that. So if I have to put in money to sell my crop, and what is this, what is this process that I have to put in money? They don't understand that actually. We did inculcate the knowledge about the commodity derivative market, but not many of the farmers are willing to come forward putting in the money actually. So what we did, we approached NABARD and we said that, like, why don't you fund it so that it will be an awareness creating activity and things like that actually. And so thereby, they will be able to. Why? Basically because we cannot fund our own margins. As an exchange, we cannot fund our own margins actually. There is a restriction. So NABARD was kind enough to fund this activity actually. So we started it and we did that, and we end up with the losses actually. But because of the price awareness initiatives that we have taken up with the farmers and the prices that we have shown up on the screen for the farmers actually, the price realization of the focus group, or the group for which we have enabled this hedging, was about 5.9% more than the last year actually. So that is 6% more than the last year, and approximately about 3% higher than the farmers who don't know these prices and the price movements actually. So the more you know how the prices are moving, the more better you are in terms of taking the right decision to sell the crops at the right prices actually. So interestingly, what we also did currently, about 6 months ago, was we did a analysis of the spot product prices for many of the grains and pulses and and some of the oil seeds actually, but it did not occur to the oil seeds. So you keep aside oil seeds for all the grains and the pulses that we have taken, right from the harvest time till to 4 months in time when it gets into the lean period. When you do the analysis, the prices, increased, from the, peak arrival period to the low arrival period, or the lean season period, increased by 10% actually. So that means in 4 months, they had an increased income of 10% actually. So when we realized, that's the increase that farmers are getting, when we saw, the prices, the minimum support prices on an average in those years actually, so the minimum support prices were lower, than the prices that remained during the lean period by about 4 to 5% actually. So in fact, what essentially it tells us is that if the government is willing to enable the farmers to hold these commodities and then fund these, finance these commodities actually, so farmers get their money into their hand. There's no interest, because government is going to waive the interest rate on it rather than waiving the interest on the farmer loans and things like that actually. And then they carry the crop across 4 months actually. So they have the money, they carry the crop with warehouse receipts, financing and things like that actually. and sell it after 4 months, or maybe sell it in installments over the next 4 months. Actually, somebody will be getting 1% more than what MSP is, somebody will be getting more than 3%. So instead of spending money on the minimum support price program in terms of procuring, holding it on the warehouses and selling it at, the lean period and things like that, why don't you sell it, why don't you enable the farmers to hold the crop and sell it at a later point in time? So when we made this as a proposal, at the higher level, then it raised many of the eyebrows actually. And in fact, we did share the data. Probably, that is one of the things that, all researchers, should be doing in terms of analyzing these prices, how the prices are moving between the peak season, the peak arrival season to the lean arrival season, and how that compares with what is the cost of holding and things like that. Actually, that's one part about price analysis. Another part about the analysis of linking the farmers to the markets is, they need the money immediately post the harvest, because, they don't earn their monthly income. They need, they earn their seasonal incomes. So these seasonal incomes may be 1 in a year, maybe 2 in a year, or at the maximum 3 in a year. But he has, daily, spending that he has to do it. So he needs some money to survive his, to sustain his livelihood actually. So to do that, if he is enabled to standardize the commodity, get a quality certificate, and put it in a WDRA accredited warehouse actually. So that's again a big challenge in the Indian markets actually. So if you look at the WDRA accreditation of the warehousing capacities, the WDRA stands for Warehouse Development and Regulatory Authority. I mean, when a year back, when we actually did a capacity development for the, for the bankers actually, at that point in time, when we talked about these, the bankers were not aware about it. So forget about the farmers. The bankers who are not to fund these warehouse receipts were not about that, not knowing about these, instruments which are there in the market actually, which help them to credibly fund the commodity collaterals actually. So they have been funding jolly well, the private warehouse receipts, and some of them were like state warehouse receipts. So you have the state backing behind that. But at the end of the day, it's not only backing, it's also the scientific warehousing actually. So if you are a WDRA warehouse, accredited warehouse, there is a mechanism by which WDRA enables that you are scientifically warehousing the commodities actually. So that's another institutional setup which has to be pretty much prevalent at that particular point in time and things like that actually. So we'll come back to it at a little later point in time, but the end of the day, the lesson was that the major benefit which was expressed by these farmers was that we had a better bargain, for our crop basically, because we know what the prices at which futures markets are trading actually. So that's the end of the day. I mean, futures markets are here not to enable the farmers to participate. And I often say that, the last ditch effort should be the farmers to come and participate in the futures market actually. The first one is to enable them to know the prices, know the fundamentals, which are the fundamentals which are moving those prices actually, so that they know, and you enable them with this fundamental information so that they know how they. So when we did this analysis, post 1 year after we did this, what happened, why it went RE, and things like that actually. So maybe when they, the broker and the consultant started taking prices, cotton prices have been heading north in terms of they have been increasing over a period in time from November 9, 2007. And, they jolly well said that now the price is around 450. If I give you 475, that'll be great. And they started executing the prices, as you saw in the table, at around 453, but they went up to 493 actually. So they have an average of 470. Came 12th December, where the world forecast for cotton crop was released by USDA, where I and Ritambara worked for, and we put out our cotton estimates actually. So there it it clearly said that China is going to import a lot of cotton in the market actually. And commoditiescontrol.com, a website which also puts out the commodity fundamental information, also raised the cotton export estimate, all of a sudden to 7 million bales actually. So end of the day, it sucked out 1 lakh out of NABARD's funding, but the news items which have moved the prices were known to the farmers, and farmers started tracking those prices and the news items on their mobile phone because they were educated how to do that and things like that actually. The farmers were pretty much more aware when we compare that with the control group of farmers who don't know what the commodity markets are, who don't know how the prices are being discovered in the markets and things like that actually. So that's a big takeaway for us actually in terms of this one. So why the farmers could not participate in the market? So having a demat account, so obviously it is not a demat account that you will have in the share market. This is having a trading account. I would say that in a way, it is an electronic trading account. In order for you to have that electronic trading account, first and foremost thing is you have to have a bank connectivity. You have to have an electronic, NEFT enabled bank connectivity. Today, all the banks are NEFT enabled, but not all the bankers are connected to not all the farmers are connected to the bankers actually, or the banks. So that's again a big constraint in terms of opening up this one. And the first and foremost is you have to have your KYC done, and in order for you to do the KYC, you have to have your the PAN card. You have to have the PAN card, and that farmers don't pay income tax actually. So why should they get the headache of having a PAN card in order for them to participate and things like that. And the liquidity on the exchange is also another problem. The expertise and sophistication, with which you can take decisions to participate on the exchange, get into the exchange, get out of the exchange, or to deliver on the exchange and things like that is another problem actually. And then the financial muscle to pay the mark-to-market margin. So when you have sold the crop at X price and the prices are moved up by 5%, 10% and things like that, this 5% and 10% would have to be paid back when the prices move to the exchange as a mark-to-market margin. So this you may be able to understand how the exchange works. You pay an initial margin, then over and above that you pay in mark-to-market margin because the prices are moving. And when you have sold the crop and the buyer has bought it, the buyer is actually profiting from a lower price at which you have sold it because the prices are increasing actually. So notionally he's supposed to get a profit actually. So that notional profit is on a daily basis deducted from your account and given to the buyer's account because the buying price is going up, and the price at which you have sold is actually lower than the buying price actually. So that is why the today's prevailing price. So the mark-to-market margin needs to be paid in cash on a daily basis and things like that. So that's a big constraint. So KMCB, there were some reforms which we'll come to it at a later point in time. But it's good that farmers end of the day knew about the derivatives, the prices, the price moving fundamentals, and they started tracking CME prices. We were surprised to know that actually they've started tracking CME prices, ICE prices, intercontinental exchange prices, and the price moving fundamentals and the USDA fundamentals and things like that. So that's a big takeaway for us in terms of to leave that particular thing. So what are the constraints? One is awareness. Two is, as I said, the financial liquidity, the wherewithal to pay the mark-to-market margins, and also the margins actually to the margins are basically deposits. It's not a fees which is taken by the exchanges. And that deposit is kept by the exchange, until you liquidate your position or until you get out of the market. That is how I would call it. And then the market liquidity. So as you saw in the execution of the contracts were executed 1, 2, 4, and things like that. I mean, it didn't have liquidity to exactly, liquidate all the 26 contracts at a single point in time, either to buy it or to sell it. And all of them happened at prices. So you need to average those prices actually. So that's again another skill set that you need to have that, unless you don't have, you will not be able to succeed in achieving the objective of participating in the market actually. And then the cost of participation. What is the cost of participation? And then, the important part is, exchange only enables a benchmark quality. Exchange doesn't enable all the cotton which is grown throughout the country to be delivered, because, to that extent, exchange has only few of the locations and the warehouses to deliver those crops. Actually, there is like select variety, and there is a given quality of that particular variety, including, the discoloration, the foreign material in cotton, and then the moisture in the cotton. So these are like fixed up right away. So you need to be aware that the quality that you grow will have to meet the exchange delivery standards. You have to get it quality standardized. You have to package it in such a way that that is accepted at the time of the delivery and things like that, actually. So, here the point is, the entire point is, the downside risk is not covered. You've sold it at a good price, but the market prices went above those prices. So there is a downside, actually. So that is not covered, actually. So at that downside, you still have to end up paying the mark-to-market margins, unless and otherwise you square off and get out of the market without delivering the commodity. So which was not done by these brokers. That's an interesting thing. We can discuss this as a case study, maybe at a different occasion, how, why and hows of whatever the mistakes that were committed by the consultant, by the broker, by the NGOs and the farmers and things like that, actually. So that itself is a huge lesson for us, actually. So the downside risk is not covered. So should options be a panacea? So today we have options in the market, that has been enabled by the merger of FCRA with SCRA. So options on futures is in the market, actually. So it's not option on commodities, but pretty recently, because of the notification by the central government, the option on commodities also came into being. So what is the difference between these two instruments is that when option on futures mature, they converge into the underlying futures contract, actually. And when the option on commodity matures, they converge by getting the commodity delivered in the market directly on the warehouses, actually. So that's the difference between option on futures and option on commodities. If you would ask me what is the predominant model of trading options, it is options on derivatives. Why options on derivatives? Because when you are trading options, you are trading volatility in prices, actually, and you are pricing the volatility. You are not pricing the price of the crop, actually. So to that extent, when you have to know what is the volatility, there has to be changes in the prices. When you know this is the change in the prices, then only you will be able to price the options particularly. And since you don't have an actively traded spot market where there is a minute to minute or even an hour to hour change in the prices, so that you will be able to optimally price the options, world over, no one has succeeded in creating option for commodities, but we have created it. Let's see, time can tell whether we will be able to succeed in creating a market for options and commodities. Because remember, an instrument which has been created for the farmer's sake cannot succeed in a financial market, basically because it is succeeded by the speculators and the arbitrageurs who are trying to build up liquidity in the market, actually. So the farmers will be willing to, let's say, buy the put option, but somebody should be willing to sell the put option, and somebody should be making it as a business option. But how to price that put option is a key constraint. And if the banks were if somebody were to enable, I can quickly think about is the banks should be enabled to sell these put options to the farmers, actually. But today, alas, the banks are not allowed to participate in the markets, actually. So you don't have liquidity, you don't have interest in among the players, basically, to how to develop liquidity in the options and the goods and things like that. They are scrambling to find their way up. Maybe time can tell us whether they will succeed and get that. And another big risk for the farmers, they did not deliver in this case, but in general, is that the quality is not up to the expectation, and whatever the quality is up to the expectation is 75% of the assured quantity which is supposed to be delivered on the exchange. So there is a loss, actually, and that loss, because if it is due to the weather-related constraints, should be protected through weather insurance. And keeping farmers aggregated against it, they would know how to get this, get through this process of getting the weather insurance, to protect them against the failure of deliveries and things like that actually. So as I said, there had been regulatory constraints, PAN card requirements, KYC norms, and burdensome paperwork, knowledge about the commodity derivative market, knowledge about trading in the commodity derivative markets. These all remained as a market-related constraints and regulatory constraints actually. And the other one is liquidity, and off and on there has been a ban on suspensions on futures trading. Dr. Ritamra can remember those bans that have happened for 5 commodities initially, then another additional 3 commodities in the next year, because may information be there everywhere. Actually, our decision makers haven't agreed that transparency is not actually a problem for them. The transparency was a problem, and they wanted to shoot down the messenger, and so thereby they can actually be able to get the market do whatever that it can do, so that none of them know at what prices market is actually trading through wheat or rice or soybean oil or potato. So even the ban had happened, but the prices have not went down actually. So that's a significant lessons for us actually, that off and on bans and suspensions happen, and that actually shakes the farmers out. So imagine in this case actually. So in this case, farmers are willing to deliver, and the farmers have participated at 490 rupees, and they were asked to leave at 470 rupees. So there is a 20 rupee loss to the farmers actually. And that's a huge loss because of the ban that has been done by the farmers actually. So then, the policy related constraints, off and on, the Essential Commodities Act, which have been there actually, which has been, put into action by the, by the government, and that actually led to the raids on storages and things like that actually. So those were like, policy related constraints, and that acted as a dissuading factor in terms of participating in the markets actually. And also it weakens the free market pricing behavior. When you have a, this one on storage, a constraint on storage, the supplies phenomenally tend to increase at that particular point in time. Demand remaining constant, the prices get suppressed actually. So basically, I don't have, my confidence in participating in a market where the Essential Commodities Act is pretty much in prevalence actually. So that's a policy constraint. And there are institutional constraints, how that can be enabled. And a lot of reforms that has happened in the financial markets and also in the physical markets, which you need to understand how these institutional reforms have been taken care. But end of the day, but that has not reached up to the farmers. That is connected to the financial market participant with the physical market more seamlessly, but it is not connected the physical market to the farmer. So we'll come back to it a little later actually. So we did a quick survey actually, and when we did a quick survey of the enablement that can be done in some of the crops the exchange was doing, the 5 being the most problematic and 1 being the least problematic. Actually, we found that in most of the elements, be it demat, having a opening a trading account, or liquidity in the near month contracts, and liquidity in the far month contracts, and the lot size, the quantity. When you buy one contract of cotton, you have to deliver 10 bales of cotton actually. So that's the quantity that you have to deliver. So the lot size is actually within the delivery capability of a single farmer or not. The expertise of the futures market, pretty much you can see the red column on that side actually. The problem with aggregation, and these are like some of the factors that we have considered, and in most of these it came out to be something like 5 for most of them actually. So somewhere we need to hit this and make it a go, but not with the individual farmers. So that's the end of the day lesson actually. So we did information dissemination. So we have to have that information linkage with the rural markets actually, so that the rural markets are aware how to bargain better price for them. So one of the things when we had this discussion with the policymakers is that, so me and Dr. Ritamra, we had been in USDA, so I had an opportunity to tour the Midwest actually. And then when we asked the farmers, do you look at the CME prices actually? They said, yes, we do look at it. Do you sell in CME? No, we don't sell in CME because we don't have the capability to sell in the CME. And I don't have a that was like way back in 2006. I don't have an active internet connectivity and a broking account or a client account with a broker. So I don't participate in the market. So what do I do is I take the CME prices and use these CME prices to bargain a better price from my trader who is buying the produce from me. It may be a Cargill, it may be a ADM, it may be a Bungi who is purchasing that crop, but I bargain the price using the local market prices, which is published on the Agriculture Marketing Service website and the USDA website, and then we take the decisions actually. So that's the end of the day, lesson that we had taken up. We had to do a lot of training and capacity building at the farmers level, and given that all these exchanges are for-profit entities actually, so such kind of capacity building initiatives can only be taken up by the public funding. So to that extent, the government should be actively engaging with the exchanges in terms of taking the price information and the fundamentals across to the farmers. And also, so today you have like seamlessly smartphones have gone into the farming, sector. Actually, the farmers, many of the farmers, let us say maybe 30-40% of the farmers might be holding a smartphone. A small initiative such as a market price enablement initiative through an app, which can be enabled by the exchange, by getting all the exchange prices and setting up an agency which can collect all the fundamentals to pour it into that particular portal, and that portal will supply the information depending on which crop you want to track, is something which can do wonderful thing in terms of empowering our farmers to take a better price decision. And that's end of the day is what is going to help them to come up with better decision making. This is another thing that we need to have group-based approach, which is FPOs actually, which we found out way back in about 13-14 years back itself actually, to say that you need to have farmers aggregation and you have to have this in order to participate in the markets. So these are some slides. I'm going to just quickly skip because I think, we are getting into the end of the session, and you can just look at it. So in order to say that it's not only an Indian experiment, and way back in 2007, Mexico had a very successful agriculture products options program, wherein the Mexican government went in and took positions on the CME market actually, and then they have provided those positions back to the farmers at a price at which they have taken it on CME, and subsidize the cost of taking positions and distributing those positions to the farmers actually, and given the options position back to the farmers actually. So it is a net to net, no loss, no profit for the Mexican government actually, in order as an activity, as a program actually, but it must have lost somewhere in the market. But end of the day, it's the farmers got a fixed price. That's the biggest benefit that they got it actually at that particular point in time. And even the US had a dairy option pilot program, and in which the farmers were allowed to buy options contract from the option writers, the OTC option writers. So and USDA has subsidized the cost of participating in the market to the extent of 80% of the this one. And Canada did for the cattle option, but somehow it did fall in between, though it was a very good this one where Canada had gotten Cargill to write OTC options contract actually, but the lack of interest and lack of knowledge about what is the cost versus the benefit of participating in the market, this initiative fell off actually. So this is basically so I'm going to send this presentation to Dr. Ritambara. So if Dr. Ritambara, if you can share with the participants, they can go through this flow chart, actually understand the self-explanatory flow in the flow chart in terms of how to deliver it on the exchange and things like that actually. And if we have an opportunity, we can even talk about the exchange operations and how to deliver it on the exchange, so that the group should be. My sincere wishes, so you all belong to the same community that I belong to, where I did Dr. Ritambara belongs to. We did our basic program in agriculture, and then we diversified ourselves into agricultural economics, and then we got bumped by chance into the commodity derivative market. Dr. Rithamra bumped back into the academic sector, but I didn't have the opportunity to bump back. So I had a tenure back-to-back with the MCX actually, and I had an experience of working with two different regulators, which is Forward Markets Commission and Securities and Exchange Board of India. It's the market which is going to be the future of the financial infrastructure, and that's going to determine the prices for the commodities. And you have to know about these markets, and you have to take these markets to the farmers. Let whatever be the enablement that can be done by the government, it is you who are the people who have to take this knowledge ground level to the farmers. Actually, sometimes it has to be available in the local language, but it may not be available. So it's you as a translator should be able to tell the farmers. And these are things which, you have to do it. So please learn about these markets so that you can take the wherewithal or the knowledge about these markets to the farmers actually. So this is an ideal aggregation ecosystem, which, I could scan through when I got this on one of the NABARD papers, recent papers on NABARD. Is that like, in terms of farmers, enablement or the NP, FPO enablement, they're saying, they should be able to enable procurement. They should be able to do processing. They should be free to sell it on the markets. Imagine they should be free to sell it on the markets, leaving aside the clutches, of the APMC Act, which has been there since the reform has been announced actually. So that's the biggest thing that they have suggested. And direct marketing has to be enabled, and inputs have to get in there, beyond the corporate constraints that the fertilizer prices are fixed and things like that. They should be able to bargain a better prices for the inputs. Should provide agro services, warehouse receipt enablement have to be done. They should also be able to access the credit and things like that actually, which is today not there. And so those are the challenges which have been lined up over there. And when the finance minister, as part of the COVID program, has announced the changes in the the regulations and things like that, one of the biggest constraints that was removed is the FM said that, like, she's moving away from the APMC restrictions actually. So today the farmers can sell it to anybody, or the FPOs can sell it to anybody actually. So one of the the successful FPO program is the Nagpur grape growers program actually. So they went on from aggregating grape production and connecting the grape farmers with the exports actually. Today they have diversified themselves into various other crops. Not only they have diversified, they have actually branded it, they have packaged it, they have started reaching this out to Mumbai and Nashik in many of the consumer-based markets, and with building up that brand in the markets and things like that. So that's a typical connect. When you make it to the urban market, you make the rupee realization out of the consumer's rupee to be pretty high actually. So that's the major enablement that has to be done. Strengthen the agri ecosystem, enable all the warehouses to be regulated by WDRA, and so thereby all the farmers or FPOs can electronic negotiable warehouse receipts and things like that actually. And they empower the farmers, or the farmer aggregates, with credit, equity and things like that, and access to technology so that they can standardize it, package it, market it in the nearby market, get the better price for the farmers actually. So that's the end of the day. Some of the reforms that we have taken, some of the reforms are pending to be taken, and those are related to the financial markets. So let's see when that gets done. Obviously, we will succeed. I mean, and the road for that success has been set up by the recent reforms announced by the finance minister. Thank you. Thank you for the patient hearing. I hope I was of some use to you, and hope to connect with you at a later point in time when I have an opportunity to tell you about how the markets function and how you need to gain these knowledge and take it to the farmers. Thanks for the opportunity, Dr. Pundir, and thank you, Dr. Rithamra. And thank you, sir. I am also having that pleasure of hearing you after a long time, actually. So thank you for that opportunity.
Thank you so much, sir. We will be taking up the Q&As later after Chandrasekhar sir's talk. And please know that the talk was really, really wonderful, as I have worked with you in this sector and I know the nitty-gritties. So you have almost covered everything, all the concerns. I'm very sure that audience has benefited quite a lot and there are going to be questions. So we will be taking you up for further lectures very soon, sir. Dear audience, now we are going to have the second speaker in the session, Mr. G. Chandrasekhar, who is an economist, senior journalist, and policy commentator, agribusiness and commodities market specialist, and is based out of Mumbai. He is a global agribusiness and commodities market specialist and is passionately engaged in analysis and commenting on agriculture, agribusiness, and commodity markets, including energy and metals, as also international trade and developmental issues. Apart from writing for India's most credible business daily, the Hindu Business Line, for well over 2 decades and appearing on business television and providing policy inputs for the government, he has been speaking regularly at national and international forums on a range of topics, including Indian macroeconomy, food and nutrition security, role of technology in agriculture, trade and investment opportunities, global and Indian commodities market outlook, and so on. Mr. Chandrasekhar has held and continues to hold several public positions. Currently, he is Economic Advisor, IMC Chamber of Commerce and Industry, International Consultant, UN International Trade Center, Geneva, Independent Member on SEBI Commodity Derivatives Advisory Committee, Member SEBI Research Advisory Committee, and Independent Director on the board of a few more companies. He has been a valued resource person for USDA, FAS, USDA New Delhi for over 3 decades and is associated with several international institutions, including World Bank, IFPRI, ICAC, Global Pulse Confederation, US Soybean Export Council, and more. He was consultant to the World Bank Government of India joint project called National Agriculture Innovation Project during 2006-2008. He was nominated by the government as independent director on the board of 2 commodity exchanges, and his columns in various publications and comments on television are keenly tracked. Associated with cultural and social activities for decades, Mr. Chandrasekhar is a stage artist of over 40 years standing and a student of Indian classical music, Hindustani style. Such a pleasure to introduce you, sir, to the audience, and I would like you to speak on business intelligence. Over to you, sir.
Thank you, Dr. Ritambra. I'm humbled and honored by this very elaborate introduction. Thank you very much. It's such a delight for me to be part of this webinar of the Anand Agriculture University. I've been associated with the agriculture markets, commodity markets for long years, as they say, for donkey's years. Okay, put it that way. And for over the next 40-45 minutes, I want to share the topic given to me is commercial intelligence. And I want to share with the participants that this is a topic I covered as far back as 1998, when I was a coordinator for the first international workshop organized by the World Bank and the Government of India and UNTAD in Vigyan Bhavan in Delhi. I was not only the coordinator, I was also a speaker. I wrote the report, and my presentation was actually on commercial intelligence. I've actually taken out a few of the slides from that presentation 22 or 23 years ago. I have updated and added value. Therefore, here we go. So how do I go to the next slide? Okay. How do I go to the next slide? I should go to slideshow.
Yeah, yes.
Right,
slideshow and enhance it.
Yeah.
Just enable editing.
You can put it on the screen.
Yeah, no, it's come.
Yes.
Okay.
Yeah.
I'm okay. All right. Thanks. Perfect. Okay. So I think before we get into commercial intelligence, and this commercial intelligence is not only for farmers, it is for all stakeholders, including the government of India in our case. It is for input suppliers. It is for output processors. It is for traders. It is for service providers, for bankers, for example, for logistics service providers like warehousing and assaying, etc. I think for all those connected with agriculture and agribusiness and food industry and trade in some way or the other, commercial intelligence is extraordinarily important. For the first proposition I want to talk about is what is the emerging scenario in our country as far as agribusiness is concerned, agriculture, agribusiness, food sector is concerned. One, very clearly, I have no doubt whatsoever in my mind that there is going to be an inexorable expansion of agriculture trade. There will be an expansion of agriculture production, agriculture processing, food consumption, and of course, food trade, not only domestic trade, but also import and export trade. Therefore, there'll be a massive expansion in the food sector, in the agriculture sector, and in agribusiness. Going forward, very clearly, the supply chain is going to get shorter and shorter. And the recent reforms that the government of India introduced of amendment to the Essential Commodities Act, contract farming, private markets, etc., is going to further accelerate the process of the shortening of the supply chain, which has been going on for the last few years. There is a lot of disintermediation, particularly after the commodity futures exchanges came into play. For this supply chain is going to become increasingly more efficient. The participants in the supply chain are going to be able to capture increasing value, and I'm sure there'll be a lot more equitable distribution of the value that is captured amongst all the value chain participants. Therefore, supply chains are going to become shorter, they're going to become more efficient, they're going to become more cost effective. Third proposition is competition from imports. Let us not be under any delusion that there will be no imports at all. India will continue to import agriculture commodities, whether it will be on a quantitative restriction or a tariff rate quota or free import, whatever. India will continue to import. We'll of course export whatever is surplus in our country. We'll also continue to import, and therefore Indian agriculture produce will continue to face competition from imports. There's no doubt at all. We cannot wish away imports. The next proposition is the entry of multinationals. Already in the last 20-25 years, a very large number of multinationals are in India's agriculture commodity space. Whether it is AD, they are called ABCD, okay? ADM, Bunge, Cargill, Louis Dreyfus, Glencore, they're all Fortune 500 companies, very large companies. Most of them are, of course, US origin. Some of them are, of course, Europe based. But they've already entered Indian agribusiness space. They run, they procure, they import, they export, they do processing and supply agri goods to the Indian market. These multinational corporations bring in, they have deep pockets. That is number one. Number two, they also have a certain slightly superior knowledge than the operators in India, because MNCs have been operating around the world in developing countries in other parts of the world. And therefore, they also bring those systems and practices and knowledge into the Indian market. Therefore, we cannot wish away the role of MNCs in the Indian market. MNCs are here to stay, imports are here to stay, but we need to learn to compete with MNCs. We need to learn to become competitive in terms of our quality and price vis-a-vis imported agriculture produce. Another point in the emerging scenario is dominance by a few large firms. Unlike the US, where the market, 60 or 70% of the market, whether it is engineering or it is pharmaceutical or it is agribusiness or any sector of the economy, banking to take, there are a handful of entities which control 50, 60, 70% of the market. And then there may be a dozen or 2 dozen smaller entities fighting for a share of these balanced 20 or 30% of the market. In India, our agribusiness substantially is fragmented, but the process of consolidation through mergers and acquisitions has already started. And therefore, I can see over the next 5-10 years, a few large firms will start dominating this market. Take the edible oil import, for example. We import about 14 or 15 million tons every year, valued at about $11 billion. Big money. There are only 4 or 5 companies, 4 companies in fact, which actually dominate this market with probably 60, 65 or 70% market share. And therefore, I think this is a trend which is going to happen, whether it is milk or cereals or oil seeds and oils or anything else, any other agri produce. This trend of the dominance by a few large firms is going to happen. Role of the government, yes, substantially stands diluted over the last 10, 15, 20 years. Government has got out of its interventionist role. Only in exceptional situations the government wants to intervene in the market, and which is good. I think the markets have to function without much of policy intervention. Use of information and communication technology is picking up rapidly, and that's going to be the way forward for this country. But for me, the most important, most critical is the integration of the domestic market with the global market. And this integration has been taking place, is taking place even today, and will continue over the next few years through the trade route and the investment route. India's import-export policy today is substantially open and free, unrestricted, unlike it was, say, 15 or 20 years ago. And today the markets are free. You can import or export any commodity, which is, there is only one list of goods. It's called a negative list, which you cannot import or export. And there is another list called the restricted list, which can be exported or imported with some government permits, etc. Otherwise, whatever entries are not there in this restricted list or banned list is all free for trade. For trade is a lot more liberal today. Investment is also a lot more liberal today. As you know, FDI in the food processing industry is allowed 100% on the automatic route. So through trade and investment, our economy is integrating with the global economy. Indian market is integrating with the global market. This is very good, but it also has its own challenges. It is these challenges can, of course, be converted into opportunities. We'll talk about that a little later how. But what is important is all those stakeholders in Indian agribusiness today need to have a 360-degree vision. It is not enough if you just know about domestic demand supply fundamentals. It is not enough if you just know about India's production, consumption, and whether our domestic market is in surplus or in deficit. You need to take a 360-degree view. You should know what's happening in the global market. For example, again, I think my friend Dr. Shanmugam had pointed out cotton. India's cotton prices in India are influenced not only by our own domestic demand and supply numbers, but also by how much is the export surplus in the United States and at what price the US is exporting. What is the production of cotton in China and what is the import policy of China as far as cotton is concerned. These are factors which will influence Indian prices. Indian edible oil prices are decided not only by our own domestic demand and supply factors, but also by the price of palm oil in Malaysia and Indonesia. That's a hugely influential factor because our import dependence is 70% of our consumption. Therefore, we need to have a global view of agriculture and agribusiness if we are particularly discussing trade because of the integration of the domestic market with the global market. Now, the topic, as I said, given to me is commercial intelligence. As all of us know, primarily it is a sentiment which moves the market, and information is a primary mover or driver of the sentiment itself. Therefore, I call information the prime mover commodity markets, of certainly agricultural commodity markets. And therefore, if you have information, having that information is key to understanding the agri-market dynamics. Markets by their very nature are dynamic. They're not going to be static at all. And therefore, you need to understand the dynamics of this market. And to understand the dynamics of this market, you need to have information. What kind of information? You need to know about weather, you need to know about input availability, you should know about the output, not only the volume of output, also the quality of output. You should know about stocks or inventory, both within the country and outside. You should know what are the demand trends, what is the trade policy of this country, what is the tariff policy of this country. Is there a customs duty on import or export, which is called the tariff policy? What are the government policies? Is there a huge amount of intervention by the government, or is the government keeping off this agriculture trade? You need to have a sense of taxes, for example, and most important, currency. You must have a view on currency, because currency impacts commodity markets, agriculture commodity prices. When India's currency, India's rupee is weak, that makes imports more expensive. When India's currency is strong, that makes India's exports less competitive. When a currency is weak, it makes exports more competitive, but imports more expensive. And therefore, we need to track these. Or a part of the commercial intelligence is to first know what are the drivers of the market, and then track them. And there are ways of interpreting this information. And information also includes the causative factors. For example, weather. If there is an aberration in weather, what is the causative factor? Is there an El Nino impact which is creating dry condition? Or I think you need to even go into the causative factors as far as the market drivers are concerned. We need, as students postgraduate students of agriculture and agribusiness, I think all of us need to make an absolutely systematic attempt to collect, collate, and analyze the market drivers. It's extremely important for all of us. Now, let us look at the characteristics of market information. Now, the question is, whatever information you have, is it accurate and reliable? Based on that information, can you take a trading call? If you're a farmer, can you decide what to plant based on that information? Or if you're a trader, can you take a trading call? Do I buy or sell or hold the stocks? So therefore, the question is of the characteristics of information. We need to ask ourselves, is this piece of information that I have, is it accurate? Is it reliable? Can I base my decision on this piece of information? Secondly, is this information timely? If there is a cyclone, it's come and gone away, and then you get information about the cyclone, I mean, that's not timely information at all. Therefore, information has to be timely. It is prior to planting that the farmers must have a reasonably good idea about weather, about the monsoon onset, the progress, the input availability. These are examples I'm giving. So timeliness of information is important. And the third one is objectivity. Is this information objective? Is this coming out of a certain bias, a personal bias of an institution or individuals, or is it completely objective, scientific? Does it have any kind of empirical evidence? For the objectivity of information is important. And the next one is exhaustive. Is it good enough? Is it large enough? Is it exhaustive enough for me to rely on it? Or is it only partial information? Therefore, how exhaustive is the information is important. Accessible. It may be accurate, timely, objective, exhaustive, but can you access it? Is it possible? For accessibility of information is very important for us to learn more and more about commercial intelligence. And finally, even if all these are satisfied, is it usable? Is this information in a form that I can use? Is it useful and use it in a usable form? is important. Therefore, these are characteristics of information that we ought to know, and we ought to ask ourselves, when you have a piece of information, does it satisfy these criteria? Now, obviously, there is a dire need for information because it is information that drives the market. And the markets, by their very nature, are dynamic. Markets, by their very nature, are volatile. You cannot wish away volatility. Markets will continue to, prices will continue to fluctuate. In India, our agri-business is growing. It has been growing over the past so many years with, of course, varying rates of growth. But the fact remains that we are growing and we will continue to grow, given the rising incomes, demographic pressure, etc. We need to be producing more and we need to be consuming more. There is no doubt at all. For our output is rising, our consumption demand is rising. There are times when we have surplus. There are times when we have shortage. There are times when we are able to export large quantities. There are times when we are able to import, or we are forced to import quantities. There's a huge price volatility. There is also currency volatility. The rupee keeps depreciating. Occasionally, it also appreciates. And therefore, we need information on all this. And therefore, what is also important is we need to have some sense, a certain in-depth understanding of the market drivers, and we should be able to foresee, forecast, predict, or crystal gaze into the immediate future. That's extremely important. It is not rocket science, but it's not easy either. It is possible. And therefore, this is what I'm going to share with you over the next several minutes. We need to forecast the changes in output, in demand, whether we are going to be in surplus or shortage, export, import activity, price volatility, and how do we guard against the risks that arise out of this volatility. That's extremely important. And therefore, because information is a driver of the commodity market, particularly agriculture commodity market, the question we have to ask is, am I getting enough information that will help me take an informed decision to do whatever I want to do, whether I'm a farmer or I'm a trader, I am an input supplier, I'm an output processor, or I'm even a service provider, I'm a banker, wherever I am in the ecosystem. Do I have information that will allow me to take informed decision? That's the question all of us have to ask. Okay. Now, sources of information. Possibly many of this could be basic, but I thought this was important to set the stage for commercial intelligence to follow. There are what is important as a journalist. I became a journalist 25 years ago. The first thing we learned was sources of information. And therefore, your source of information and the reliability of the source of information is extremely important. And therefore, sources of information are far too many. Sources of information are far too many. For example, you have industry and trade body publications which are available, whichever commodity or whichever crop or whatever you talk about. I'm sure there are many trade and industry body publications. For example, if you want to talk about oil seeds and oils, you have the monthly newsletter of the Solvent Extractors Association of India. Extremely useful document. A very, very interesting document. Then you have, of course, reports from analysts and consultants and, of course, experts. Research firms are also able to give you a research report, but obviously it comes at a price. You need to pay them. But the most important repository of information is the government itself. The government of India has a lot of information with itself. I don't know how many students who are now participating in this actually look at the Agriculture Ministry website. Every week, the Weather Watch group comes up with a report on the monsoon and report of the acreage planted planted during the Kharif season. It runs from June to September, and then for the Rabi season from November to February. I think that information of the acreage planted, yes, it is surely coming with a certain lag in time, but it's an extremely useful information for us to know the trends in planting of various crops. Similarly, the Directorate of Economics and Statistics comes up 3 or 4 times a year with crop estimates. You may or may not agree with that crop estimate. I have often commented and even criticized the way the crop estimates are made, but that's a good benchmark for you as far as crop size is concerned. Although private forecasters and trade associations also come up with their own estimates. Therefore, government itself is a repository of a lot of information. The DGCIS, Director General of Commercial Intelligence and Statistics in Calcutta, they come up every month they issue their bulletin of import and export activity. I think these are important sources of information which students in agribusiness ought to know, and they should access and then try and use that information. Now, the question is, how good is publicly available information? Is it reliable? Is it accurate? Is it objective? Is it timely? Is it accessible? That's a big question. For example, if you have estimate of the cotton crop, the Agriculture Ministry comes up with one estimate, the Cotton Advisory Board comes up with a second estimate, and probably the Cotton Association of India, the trade body, comes up with another estimate. There are 3 different estimates. Which one would you rely on? And therefore, the reliability of that information becomes suspect, and possibly the truth would lie somewhere between the 2 extremes of crop estimate given by 3 different agencies. Therefore, we need to know, and it comes only through experience, to sift the wheat from the chaff and get to know what is the correct crop number that you should be working on. Oil seeds, for example, again, the Agriculture Ministry comes up with an estimate and the trade comes up with another estimate, and often there is a divergence in these estimates. Therefore, the very process of estimating these crop numbers comes into question. And that reminds me, and the third one is foreign trade data, import and export data, published by the DGCIS. It comes with a lag. And because it comes with a lag, it loses its utility because it's history. By the time the information comes out, or you're able to access it 3 months later, it's become history. It doesn't help you. Therefore, delay in dissemination of information with government is again another issue. That brings me to another aspect of how government of India can play a very significant role in disseminating agriculture and agribusiness related information. I have been a resource person for the US Department of Agriculture from 1984. From the time their office was set up, the Foreign Agriculture Service was set up in the American Embassy in Delhi in 84. I've been a resource person for them. They come up with a monthly report. I don't know how many of you actually access the USDA website to get their reports on grains, on cotton, on sugar, on oil seeds and oils, and a whole lot of other things. And they track more than 100 countries, and all that report is available in the USDA website. I think we need to have that kind of, and it comes out every month. 10th or 11th or 12th of every month is the report of the USDA crop report. Therefore, we need that kind of a strong, methodical, systematic dissemination of agri information in our country. And this is something, again, as I said, I had spoken about it in 1998, and I feel a little awkward. I have to repeat that 22 years later. But nonetheless, I think if even at this point of time we are able to put together some kind of reporting system for agribusinesses in India, I'll be very happy. Similarly, the International Grains Council in London, they come up with their market report every year, every month, which is extremely important. They also give their projections for the next 5 years. I think these are great pieces of information that will give you a very good insight into agribusiness. For this information, availability of information, reliability of information, access to information is called soft infrastructure. We have in our country inadequate hard infrastructure, solid infrastructure, whether it is warehousing or silo or cold chain or grading and sorting facility, rural infrastructure, the hard infrastructure is inadequate. We are investing, of course. We are developing, we are investing in hard infrastructure. We should be equally focused on building soft infrastructure, which is information, a system of collection, collation, analysis, and broadcast of information. But we need to build our soft infrastructure for the country so that all the stakeholders in agribusiness are able to take an informed decision about what they should be doing. Okay. Let me talk about global commodity market. This is true for all commodities, including agriculture commodities. What are the other commodities you can talk about? Energy products like crude oil and natural gas. Then you have metals. You have industrial metals like steel and iron ore, base metals like nickel, aluminum, copper, zinc. You have precious metals like gold and silver. And of course, you have agriculture commodities. So commodity markets are divided into these 3-4 broad baskets. Now, agriculture markets are substantially driven by these 1, 2, 3, 4, 5, 6. There are 6 major drivers of agriculture commodity markets in the world. One is economic growth. There is a strong positive correlation between global economic growth and commodity consumption. If you track last 100 years of global growth and commodity consumption, you will know there's a very, very strong positive correlation. And there are some commodities which are actually called growth commodities. For example, crude oil. When the economic growth picks up, crude oil consumption goes up. When economic growth goes up, copper consumption goes up. When economic growth goes up, cotton consumption goes up. Okay, and therefore this relationship is very well established. And therefore, as the students of agribusiness, you need to be tracking economic growth, global economic growth, and then try and see how agriculture commodities move in tandem with the growth movements globally. The next driver is geopolitics. Geopolitics refers to a situation of political instability, a warlike situation, a threat to some country. And when this geopolitical development centers around the Middle East region, which is a large producer of crude oil, geopolitical developments immediately impact the crude oil market and crude oil prices. There is always a threat of disruption to crude oil supplies, and therefore crude oil prices start moving up. Crude oil prices have a strong relationship with agriculture commodities. Crude oil prices have a strong relationship with agriculture commodities. Often people have wondered, even top industry people have asked me, what kind of relationship would crude oil have with agriculture commodities? When crude oil prices go up, the cost of agriculture production, particularly in industrialized nation, starts to go up. The cost of production goes up. You have the price of synthetic fertilizer goes up. The cost of mechanization goes up. The cost of processing agriculture commodities will go up. The cost of transporting, ocean transport, because the freight rates will go up if crude oil prices go up. That will go up. Therefore, geopolitics also has a direct bearing on the cost of production of agriculture commodities. and therefore, through the crude oil route, geopolitics exerts a certain impact on agriculture commodities, which we should know. The third one is monetary policy. Different central banks of different countries follow different monetary policies. Some have very tight monetary policies with high levels of interest rates. Some have loose or accommodative monetary policy with low levels of interest rate. All of us know what has happened in the last 6 months across the world. The US now follows a near zero interest rate policy. Even in our own country, interest rates have dropped only to fight the pandemic. When you have an accommodative monetary policy, there will be a lot more liquidity in the economy. And when you have a lot more liquidity in the economy, it will push commodity prices up, because a part of this liquidity will move to the commodity markets, and there could be more and more of speculative investment in commodity. Therefore, higher the liquidity, the propensity of commodity prices to rise. Okay? Then we come to currency. This is extremely important. Currency fluctuations impact particularly agriculture commodity trade. When India's rupee depreciates, it makes exports more attractive, but it makes India's imports more expensive. And therefore, that's the effect of currency, which we need to track, and we need to have an outlook on currency. Weather. It's a no-brainer to say that weather is a major driver of agriculture commodity markets around the world. If we have a fairly good weather, good rainfall across both hemispheres, northern and some of the southern hemisphere, the chances of agriculture commodity production rebounding is very high. But the weather is not uniform across the world all the time. You have weather phenomena like El Nino and La Nina. Particularly El Nino is a phenomenon that brings dryness, much lower rainfall than usual. And global warming and climate change in recent years has actually accelerated the aberrations in weather around the world. And therefore, it's extremely important to track weather developments around the world, particularly in major agriculture crop producing countries such as the United States, like Brazil, Argentina, Europe, of course, South Asia, etc., etc. I think that's extremely important. But last but not the least, the funds, the speculative funds, the mutual funds, the pension funds, speculative funds, hedge funds have a big role to play, because the hedge funds actually track the preceding 5 factors and then take a view. These 5 factors: economic growth, geopolitics, monetary policy, currency, and weather, give an indication of the likely behavior of agriculture commodity markets and agriculture commodity prices. And then funds take a trading view, a trading call based on their analysis of the preceding 5 key drivers. Therefore, as students of agribusiness, all of us have to know these are the 6 key drivers of agriculture commodity markets, and these certainly influence agriculture commodity prices. Now, agriculture commodities, as all of us know, face multiple risks. You have production risk. What if there is a monsoon failure? There'll be no production at all. Or there'll be limited production, or production will shrink. You may have large production, but there's no guarantee that the quality is also good. And therefore, there is quality risk. You may have production, you may have quality, but there could be trade risk. Maybe the processing companies, processing industries are not going to be buying in quantities that they are usually expected to buy. There could be policy risk. The government may ban import or export. Government may impose tariffs. They may impose other restrictions like the essential commodities, which of course Essential Commodities Act is now substantially diluted. But I'm saying these are policy restrictions which were very real at in this country at some point of time or the other, and there could be currency risks. So there are multiple risks which agriculture commodity markets face and stakeholders in the agriculture commodity space face. These multiple risks of production, quality, trade, policy, currency are called underlying risks. And all these underlying risks converge into one factor. And that one factor is called the price. Okay? All these underlying risks converge into price. And therefore, if you are able to manage that price or manage the price risk or manage the volatility of price movement, you would have indirectly managed all the other underlying risks. And therefore, management of price risk is extremely important for all the stakeholders in the commodity market ecosystem. And the futures market or the hedge markets, the hedging system in the recognized commodity futures exchanges could become a good benchmark for you to even follow forward prices that are disseminated through commodity futures exchanges. Now, market outlook. Okay, we have seen the drivers of the market. We have seen how information impacts the market. How do you take a view about the market? What is the how are prices going to behave? Say over the next 2 months, 3 months, 6 months. How would the farmer decide in the month of April or early May what crop he's going to plant? Or how would an input supplier 3 or 4 months earlier, say even in January or February, decide how much stock he must carry of seeds and fertilizers and agrochemicals? How much will be the demand for the upcoming Kharif planting, for example? Therefore, market outlook is extremely important. There are 2 approaches to market outlook or price outlook. One is a fundamental approach. In the fundamental approach, we just look at broad numbers. The numbers would be something like opening stock, production, plus import. If you have opening stock, you have domestic production and import, that makes for total supplies. Okay, that's on the one side. On the other side, there could be domestic consumption and there could be export. For domestic consumption plus export is called disappearance. And therefore, supplies minus disappearance will lead to closing stock. Okay, this is a fundamental approach to price forecasting. If the closing stock is going to be lower than the opening stock, which means either the domestic production is going to be lower or exports are going to be higher, that will give you a certain signal. Okay, and therefore, that if you have those fundamental numbers, you will be able to know whether the market is getting into a surplus situation or the market is getting into a deficit situation. If the market is getting into a surplus situation, it is reasonable to assume that prices are going to be stable or possibly a little soft. If the market is going to get into a deficit situation, depending on the size of the deficit, the prices could obviously start rising. If the deficit is a very large one, prices could spike, and therefore I think that kind of fundamental approach to price forecasting of the market outlook is extremely important. The next one, the other approach is of course the technical approach. Technical approach presupposes that there is a pattern in everything that happens in the market. There's a pattern in everything that happens in our life. And therefore, there is a pattern in everything that happens in our market. For the technical analysts, track the price movements over a period of time, and then are able to give an outlook about how prices are going to go. Technical analysis is a very well accepted way of looking at the market. And there are just so many what should I say, scientifically tested methods like the Elliott wave method, etc., etc. All that I'm sure you will be able to get from academic literature. So the question often people ask me is, should I follow fundamental approach or should I follow technical approach? I would say follow both. It is not fundamental or technical. It is fundamental and technical. Follow both. I follow usually the fundamental approach, and often my technical analysts who are my friends would call me and say, sir, where do you see gold prices going? Then from a fundamental perspective, I'll tell them what my outlook is, and they would, from the technical perspective, whether it fits into their logic or not, I don't check, but I share my perspective. But technical approach is as important as fundamental approach for market outlook. Okay, now agriculture market reforms. We've seen early June 3 big announcements that came on dilution or amendment to the Essential Commodities Act, a legal framework for contract farming, and of course allowing private markets in addition to or sorry, in competition with the APMC markets, e-trading, etc. I think these are very significant developments for India. The success of the agriculture market reforms would lie in its implementation. We need to implement these working with the central government to ensure that these reforms are carried out well. As students of postgraduate students of agribusiness, it is extremely important, in my view, for all the stakeholders and for all the students to first research before you take a decision. You want to trade cotton, or you want to trade sugar, or you want to trade soybean, maybe whatever. You need to research that product. You need to have adequate product knowledge, and you need to have adequate market knowledge. And only then you will be able to have a reasonably good market outlook or price outlook. Therefore, there are ways of doing research. Obviously, I don't think I have that kind of time. I don't have the luxury to deliver a lecture of several hours, but we will. Maybe there is another opportunity to talk about all this. For research is extremely important. Your sources of information are important. Access to these sources of information are important, and your interpretation of data. Sorry. Interpretation of data is extremely important. Data by itself has much less meaning. How do you interpret the data, and what conclusion you come to is extremely important. Then we come to the topic. Today's topic is FPOs and commodity markets. FPOs, I do market outlook and price outlook for FPOs in different parts of the country. There's Gujarat, Maharashtra, so many other places. I tell them that I can't teach you what seed to plant, or how to do agronomy, or how to do the harvest. They are experts. They have done all that through their life for generations. But in my view, what they lack, and they accept, they concede, and they appreciate what I tell them, what they lack is a market outlook, the price outlook. Where would prices go 1 month, 2 months, 3 months from now? What are the factors that will drive these prices and these markets? What is happening around the world? What's happening in India? And how would these impact, whether it is maize or cotton or soybean or pulses, whatever commodity that you talk about? They need certainly hand-holding in terms of commercial intelligence. I think this is a campaign which I would think the Anand Agriculture University should possibly start I'm willing to be a part of this campaign, because what is important, if farmers and FPOs have to reap real benefits out of these agri-market reforms, farmers should become savvy traders, and farmers will become savvy traders. They have the capacity to become savvy traders, but they will need hand holding. So I've often in the last 20-25 years said, I said, हमारा किसान शायद अनपढ़ होगा, मगर वो अनाड़ी नहीं है. He is as smart as anybody else. He is somebody who understands everything. But we need to build capacity in him to face market volatility. We need to build capacity in him to have some kind of market outlook, and create facilities for him to take advantage of this upcoming market outlook. And therefore, from that perspective, it is extremely important that farmers are trained and given from time to time a talk or lecture or education, training and awareness about commercial intelligence and market outlook. The second one, farmer producer companies should also be trained in exports. Value addition and export, in fact, both will go together. All farmers have been in our country simply primary producers. Yes, that's a core activity, primary production, and therefore they are primary producers. But I think the time has now come for all of us to take them one level higher, that they become savvy traders. They add value. They sell value-added products. They export and get the benefit of export markets. And therefore, value addition and export is again another area which I'm talking about. It is also important when farmer producer companies want to start value addition. Maybe they'll have their own processing facilities, food processing facilities, and maybe they'll have their own export markets. They should be able to develop strong banking and documentation skills. This is something which they lack, which I'm aware. I'm not a banking expert. I'm not a documentation expert in terms of import-export, but I do tell them that these are areas of weakness which they need to take forward. I'm also thinking there are more than 500 KVKs around the country, and there are probably 5,000 FPOs in this country, farmer producer companies. Can KVKs and FPOs join hands? Can they join hands to lift the entire agriculture and agri business space in our country? They're thinking a lot. How it will happen, how it will pan out, I still don't know. We need to think through. But this is an idea that just occurred to me last night when I was thinking about this webinar. Let me go to the next. Do I have 5 or 7 minutes more? 5 minutes more?
Yes,
okay,
sir.
All right. Thanks. Okay, great. Now I'm.
Please continue, sir. Please. Yeah.
Yeah. Okay. Having said all this, I want to very quickly look at the post-pandemic scenario for the benefit of our students primarily. World over, we cannot wish away a significant slowdown in globalization. Globalization will not reverse, but may not be further progress in globalization, but there will be protectionism. Countries are going to protect their self-interest. And often I've found, even in the last 10 years, most governments, most administrations ride on the horns of a dilemma. And what is a dilemma? Most governments, whether it's the mighty United States or India or China or whichever country for that matter, they ride on the horns of a dilemma. The dilemma is every government has a certain domestic, socio-economic compulsion. They need to meet the aspirations of people. They need to protect domestic interests. They need to ensure social advancement. They need to ensure economic growth. within the country. So they have those compulsions to fulfill. Domestic, socio-economic and political compulsions on the one hand, and every country also has certain international obligations under the WTO, under bilateral treaties or multilateral treaties, whatever. So there is a friction between domestic political compulsion on the one hand and meeting international obligations on the other. And this friction creates a big dilemma for various governments. And I found often that the domestic socio-economic and political compulsion outweighs and outscores international obligations. The US, the champion of free trade, champion of globalization, is now saying, make America great again. Okay, we are talking about Atmanirbhar Bharat. And for this is going to be the trend going forward. Atmanirbhar Bharat does not mean that we are going to insulate ourselves from the world. No, we are going to be producing as much as we can, as efficiently as we can. We will have to continue to remain in the global value chain because no country can produce everything that it consumes. And therefore, we much as possible, we should produce within the country. Government policies post-pandemic, I expect, will be increasingly welfare-oriented. And we are seeing it across the world. Even this welfare orientation will continue even after the pandemic has gone away. And hopefully, I want to see the end of this pandemic in the next month or two, hopefully. So governments will become more and more welfare-oriented. I can see clearly, increasingly, every government, I'm not just talking about India, most governments, there'll be increasing emphasis on food security. And that food security emphasis will come out of local production. Countries will try as much as possible to reduce dependence on imported material. There are occasions when there'll be no choice but to import. Edible oil in our country, we're not going to be self-sufficient anytime soon. There will be import. But the emphasis, policy emphasis, will be increasingly on food security through local production. I'm also seeing very clearly consumers are going to be demanding health food, and they will adopt healthy lifestyles, which opens up another opportunity for food processing companies to come up with health food that the consumers would need. Identify very clear niche health foods for supply to consumers. Most important, I foresee a faster adoption of technology in agriculture, agribusiness. I am able to foresee Indian agriculture will be increasingly mechanized. There'll be acceleration in the mechanization of agriculture. There'll be more digitization, more automation, particularly in production, in processing, in supply chain management. For example, in import and export trade, there'll be adoption of blockchain technology. There'll be adoption of multiple technologies, in agriculture, information technology, agriculture biotechnology, satellite technology, nuclear agriculture technology, nanotechnology, use of drones, etc. All these multiple technologies will come not only in agriculture from a production perspective, but post-production, obviously it will be digitization, automation, etc. in processing and supply chain management, etc. Therefore, this is a scenario I'm able to foresee. With this, I think I'll end my lecture. I can go on for another 10 minutes or so, but I think I'm okay with this. Good luck and God bless you all.
Thank you so much, sir. It was an excellent talk. Before we take up few questions from the audience, I request Dr. R.S. Punir, my PI, for some comments. Sir, over to you, please.
Dr. Mugan and Mr. Chandrasekhar, sir, it is really wonderful listening to you both. I think we have no words. Even Mr. Chandrasekhar, the way you have talked the issues, now we are finding that we are having this center, a very prestigious center on agriculture market intelligence, but earlier people used to think that is very limited to only price forecast. But the horizon is more than that. Maybe towards backward, maybe the input sites and its information and food, maybe thereafter, maybe price forecast only one segment of this commercial intelligence or market intelligence you are talking it. I think we have to think about this in a detailed way. But let me tell you what we are having. There are 4 objectives under this project to both of you, sir. And we would like your association in this project. Already, Sunmugan Saab, Dr. Ritambra is associated with you. But Chandrasekhar Saab, we would like you to be associated in this project. Definitely, shortly, we'll be communicating with you. There are 4 basic objectives. One is on price forecast, demand and supply. Detailed one. And then it is a global intelligence you're talking, and in your talks, in both of you, particularly Chandrasekhar Saab, your talks, global intelligence, analyzing the information, rigorous analysis and generating the intelligence and making it available to the stakeholder, particularly the farmers. This is a challenge. And then this marketing, and within marketing, this not only marketing, what usually we do, but ENAM, how to make it successful, ENAM, contact farming, APOs and commodity markets now. Conducting research, generating intelligence and making available the way it needs to be to particularly farmers. And then, of course, these commodity markets and farmer producers organizations, this is today's, I think this webinar is centered to that. But these 4 areas, earlier people used to think that this market intelligence is only limited, again I am saying, to price forecast kind of thing. It is not. And at least it is very clear from your talks. And even we are having these views from other experts also. So, sir, really very nice listening to you, both of you. And it's a great opportunity to all of us, and we will get you associated in this project further. Over to you, Ritambra, with these few words, because this is continuous session. Please, sir.
Thank you so much.
If I may say,
Sunmugan, Doctor, yeah, please, sir.
Would have loved to come to Anand and deliver this lecture. Okay. Shanmugam, bolo.
Yes, sir. So I'm just following your lecture, actually, Mr. Chandrasekhar's lecture. So my suggestion, I have a quick suggestion, basically. I mean, so you have a crop forecasting, a wonderful crop analysis activity in the this one, actually. As Sir suggested, it is that we need to take it to the farmers, actually. And that quick suggestion is about, what do you think about doing an app? Actually, in the app, from time to time, it's not necessary that you have to collect this price information within the department, and you should start disseminating it. And number one. Number two, you should start, training those, people who are going to train the farmers, basically, to how to interpret this information. One may be about the nearby market prices, 2 may be about the global fundamentals, 3 may be about the Indian fundamentals, and all those news items which are coming into and things like that. And 4 may be about how do you forecast, and why do you forecast, and what you forecast, and what are the negatives about, forces behind the forecasting and things like that, actually. So that can be done, if you can create an app, actually. So I've seen this in universities, setting up the commodity price analysis and forecasting centers. End of the day, it just remains within the universities and, as an academic exercise or something like that. But I think, you need to take that step beyond the walls of the universities and take it to the farmers and, make them understand, and they're going to, vouch you for your existence, actually.
Very true.
Yeah, Chandrasekhar, sir, you want to add?
Yes, sir. Sorry.
No, okay. No, I said I would have loved to actually visit Anand and address the students. There's a lot more that that one can actually talk about as far as agriculture is concerned. The domestic challenges to agriculture, external challenges. How do we overcome these challenges? Need for policy support, research support, investment support. I mean, there's so much to talk about. But I'll be happy to mentioned my friend, so we'll be happy. Says Alma Mater. He's from the. I'll be. Will. मैं आपको बताता हूँ, आप बताइए. I'll be.
Sure.
Yes, Dr. Ritambar, I think it's a great thing. We are looking this kind of opportunities, but sir, we would love it, and we would welcome you, and we'll be in your touch, definitely, sir. Yes.
Certainly, sir.
Yeah.
Thanks to both of you. Yes, Dr.
God bless
Ritambar,
you.
over to you, please.
So, sir, we are going to take questions now. And okay. So the very first question is for Dr. Shanmugam, sir. Am I audible to you, sir?
Yeah.
I can hear you actually.
Okay. So the very first question is, what should be done to encourage farmers' participation on the commodity exchanges? So, yeah.
So I would say that, so I think, if I have to take it backwards, actually, one is create aggregates. Farmers in themselves will not be able to participate on their own. They will not have that professional capability to participate in the exchanges, actually. I would say that, the government should encourage, setting up more FPOs. Actually, it's time that, we set up more FPOs or farmers aggregation, and those aggregation come and participate on the exchanges, actually. And there are a lot of things which needs to be done even in the FPO, scenario as well, in terms of professional management. Basically, this is where I think, this should be a subject within this agribusiness management, so how, to aggregate the farmers, actually. So I would rather take a step little further forward to say that government should set up a regulatory agency for FPOs, actually. So how do they function? How do they aggregate? How do they account for whatever the activities that they do, actually? And then how do they create that trust among the farmers and things like that. So so in my experience with the the exchange in the past, few the aggregators, the FPOs came into the exchange to hedge their cotton, which is the processed cotton, the ginned cotton, actually. But end of the day, but they were not having access to the credit, and so they couldn't come and participate in the exchange, which is a big constraint, actually. So how would we enable that credit? And you, as professional managers who have done their agribusiness management, actually, if you just get into that rural area and get done, there is a lot to do it at that particular, this one, in terms of connecting the FPOs to credit. And so, having set this aside, actually, so this Maha Grapes, which is the Grape Growers Cooperative Federation, is a huge successful example which is standing in front of you in terms of, like, how to replicate this sort of an exercise in other commodities, in other areas and things like that, actually. So that's more important. So how to enable it? Aggregation, information dissemination. So here is where you as Center for Crop Prices and Forecasting things should be doing it. Create a small and simple app. It's not going to cost you more than 1 lakh rupees, and use this app basically to disseminate prices, fundamental information over to focused group of farmers. Just don't spread your activities across the crops. Do it for the focus group of farmers. They'll come, they will appreciate it, they will provide their feedback, and then from them, their friends will come and talk about more crops. Then you diversify yourselves into more crops over a period in time, actually. So that is price enablement and professional enablement. And once these are done, aggregates are in place, I think that's going to automatically kickstart participation in the exchanges for risk management. Don't participate for trading, do it for risk management.
Thank you so much, sir. That was excellent. And I would like to share with you that we have already the provision of creating an app in this project. So we are already on those lines. And I think with those kind of inputs, that has only added value to our thought process. Thank you so much, sir. Mr. Chandrasekhar, sir, there is another question for you I would take up. Sir, I'm audible. If I'm audible, Chandrasekhar, sir?
Yeah.
So, how the structure of global agriculture trade changed due to COVID-19, and how trade policy change is expected due to this situation?
The first one is there has been a massive disruption in the global supply chain. Okay, because of disruption to production, to shipping, and to trade. In the supply chain after lockdown was announced from with effect from the 25th of March. Okay, and therefore this is what has happened around the world. First, China was virtually locked down for several months, beginning January, and therefore different countries adopted different ways of tax. Somewhere impose very overall global agribusiness certainly got disrupted. It's slowly coming back. It's finding its feet. I expect by the there is the pandemic is, we know whether it's going to come under reasonable control. If, and it's a big if it comes under reasonable control by the end of the year, say the last quarter of the year, then 2021, the global value chain or global supply chain will start accelerating towards their normal activity. Having said this, don't expect the same kind of GVC, global value chain, to continue, because there will continue to be disruptions based on the policies of every country. If India as a nation is talking about Atmanirbhar, then we will obviously, our attempt will be to, as much as possible, discourage imports, as much as possible produce more and become self-sufficient and self-reliant. But there will be countries with huge surpluses. What will the US do, or what will do with all the sugar, cotton, and and therefore they will all be looking for outside. Therefore, they will be wanting export markets, whereas other countries would be wanting to control their imports. For this is going to create some kind of continued disruption, but over the whole of 2021, depending on prices, depending on local compulsions of various countries, the supply chain, in my view, will slowly start getting normalized. But I am not able to foresee, even towards the end of 2021, I'm not able to foresee that we will go back to the end of 2019. Whatever was the situation towards the end of 2019, last quarter 2019, whatever was the situation, I don't see we will reach that situation even towards the end of 2021. There will be disruptions, but there would be adjustments, and the impact of disruptions will slowly start declining. Within this, what if there are weather aberrations? Supposing you have somewhere an El Niño phenomenon, or there's a drought somewhere else, the whole policy will change. If a country like, if God forbid, hona to nahi chahiye, but if India were to face a drought next year, 2020, what happens? I think our Atmanirbhar will go for a toss. There is nothing which we can do, because feeding people is most critical. And therefore, there are, while there are intentions which will be pursued, there are things called supervening impossibility. There are natural phenomena which may force you to deviate from your core commitment of protectionism and Atmanirbhar. So it's a very dicey situation. But don't expect the global value chains to go back to where they were in the last quarter of 2019 for at least 2 more years. Yeah.
Wonderful, sir. I think students now get an idea what is 360-degree view of the situation. You have taken it so well. Yeah. Shanmugam, sir. So there is someone who has asked, what is the status of price discovery on the commodity exchanges, and how much of hedging does really happen? And then additionally, what benefit can bank participation bring on the commodity exchanges, and why are banks still not allowed?
Okay, so let me answer it one after another actually. So
Yes.
what is the level of participation in agriculture commodity derivative markets? So of late, I could see that, the agriculture commodity derivative markets, the participation has been going down, but that's actually something which is probably, as exchanges, have to take up market development activities in terms of more outreach and things like that actually, and in terms of bringing in more products onto the exchanges and things like that actually. So that's number one. So it's been declining, but obviously so during the pandemic and and now the spot prices are rarely coming out of the markets, and since spot prices are not there, the participation is going down, and so the volumes are going down and things like that actually. But obviously this situation is going to correct as the pandemic, as we are coming out of pandemic and supply chains, or as Sir was saying, supply chains are coming onto their feet, and price discovery in the spot market is coming onto the foot. The volumes are going to improve over a period in time actually. And so what is the hedges participation? Hedges participation, to be more frank with you, should be about even if it is about 1% of total, actually I will be very happy about it. But that participation is very low actually. That is more important. So hedgers are the bone or the backbone of the markets actually, and if they are not participating in the market, there is something wrong with the entire market and the market mechanism and the price discovery. And that's one of the reasons exchanges have been conducting awareness programs among the possible hedgers and things like that. Here in agriculture, the hedgers are basically agri-processing companies and things like that. So, so to say that, if you're talking about processed agri-commodities like, cotton, edible oil, we could see a little bit of hedging activity which is going on over there actually. But if you are talking about the broader agriculture commodities such as rice, wheat, or pulses, not much of participation is happening. And that is also basically because few of the reasons which have been removed by the government, which is basically one of that is Essential Commodities Act. I mean, people do not want to participate in any of the pulses futures basically because if Essential Commodities Act is enforced, I mean, you never know when government will come and seize my commodities. So that's another big problem actually. So these constraints would have to be removed. We need to take it to the corporates. We need to take it to the FPOs. We need to scale up our FPO experimentation and things like that actually. So that's how we can increase the hedging participation. So what role, why banks are not allowed? Banks are not allowed because as per their RBI Act, which was, during the time of our, independence, since we didn't have a proper commodity market, and nobody knows how the commodity market works and things like that. So our the lawmakers have thought that banks should not be allowed to do anything which is related to commodities. So be it commodity derivatives, be it commodities, spot markets, it's plainly says that banks are not allowed to do anything to do about the commodities actually. So so in a way now the system is changing because bank brokerages have come up. HDFC Securities is distributing commodity derivatives. ICICI Securities is distributing commodity derivatives. Banks are allowed to do clearing of the commodities actually. And lastly, banks will bring in liquidity. Banks have the huge balance sheet. Banks can build markets and do market making. Sir, sorry for continuing it. You have few points to make.
No, I think I'm okay.
Sure, sir. Can you do it? Okay.
All right. Okay. Let me take this thought forward. Even if the banks are not allowed to trade commodities, I believe, and I've said it several times in the past, it is important for the Reserve Bank of India to direct all the banks to ensure that the borrowers of loan from the banks the banks mandate that the borrower hedges his commodity risk in a futures exchange. I have not been comfortable in the thought that banks themselves should be allowed to trade commodities. And I don't think Indian public sector banks have that kind of domain expertise to trade commodities. Even otherwise, they have accumulated huge amounts of NPAs, as all of us know. And therefore, I have not been comfortable at all. But the regulator may perhaps allow banks to start trading commodities. Their broking arms are now allowed to trade commodities. But what is important in my view is banks must insist on the borrower to demonstrate that if the borrower has borrowed against commodities, if he has exposure to commodities, that is, he has hedged the price risk in a commodity futures exchange. That should become the activity of the banker, because the core dharma of a bank is to lend money and not trade commodities. And therefore, insisting on the borrower to hedge his risk will make a lot of sense, in my view.
Thank you so much, sir, for your view. There is a concern for edible oils someone has raised. And the question is, number one, regarding the palm oil that the government has recently promoted, why the palm cultivation is getting so much promotion, despite the fact that this is not the commodity which is healthy in nature, and we have so many other oils also. And second thing, if that is put aside, if through the FPOs, the edible oil production can be increased. So either of you may take this call. Yeah.
I've written extensive commentaries on this.
Yeah.
I'm also writing a kind of policy paper for the Agriculture Ministry, by the way. There are two things. One, palm is a highly productive crop. It takes 4 or 5 years gestation period for the oil palm trees to start growing and start maturing and start to give fresh farm fruits, FFBs, fresh farm bunches. Per hectare of oil palm plantation, we are able to get 4 tons of palm oil. Per hectare of groundnut cultivation or mustard cultivation, our yield is only 1 ton of groundnut or mustard. Even if you produce it in 2 seasons, Kharif and Rabi season, it will be 2,000 kilograms or 2 tons. And if you recover 40% oil from that, which is the oil content, you will get less than 1 ton of oil when you cultivate, say, oilseed crops. Palm oil 4 times efficient. But a lot when the first report on oil palm came, it was called Chadda Committee report, which identified 1 million hectares of land under oil palm. Where have we moved in 32 years? Our oil palm acreage is less than 3 or 4 lakh hectares. I think it's just lip service. Recently, the government, I think the Prime Minister talked about promoting oil palm in the Northeast. Very good. Why not? But we must analyze the reasons. What are the weaknesses in the current system? Why we failed to promote oil palm in the last 30 years? Address those weaknesses. Merely saying that we must produce more of palm oil is not going to help. We need policy support, investment support, research support. Only then we will be able to produce more palm oil in our country, which will result in reduced dependence on import of palm oil. Number one. Number two, there are concerns. I think if I heard you correctly, there is a health concern about palm oil. I don't believe there is any health concern about palm oil whatsoever. When a vegetable oil is refined, there's very little difference between refined groundnut oil, refined palm oil, refined soybean oil, or refined mustard oil. Therefore, I think the health concerns are highly exaggerated from a human health perspective. Yeah, the second question was on FPOs. Should FPOs, do we take their help? Do we take their help to promote oilseed cultivation?
Yes.
Was that the question?
Yes.
Without doubt, FPOs can play a big role, but we need to create an enabling environment. I have argued on many occasions in the last 10 or 15 years, in fact, in Punjab, Haryana, and in UP, Western UP in particular, this country practices what is called grain monocropping. Rice, wheat, rice, wheat, rice, wheat cycle. This grain monocropping has resulted in a complete deterioration of soil health in these states. It has pushed the water table down to alarmingly low levels. There is an ecological disaster waiting to happen in Punjab, Haryana, and Western UP in particular. We need to slowly move away from grain monocropping and start cultivating pulses and oil seeds. And if we cultivate their pulses and oil seeds for crop diversification, for crop shift, I think FPOs there can play a significant role in promoting oil seeds because they are legumes. Both pulses and certain oil seeds are legumes. They will also do nitrogen fixation in the soil. That's going to be very, very positive. Therefore, there are strategies, there are ways of doing it. But as I said, we need political will to bring about change. I see certain, I don't know, I should call it lack of political will or inadequate political will to bring about changes. We need transformative policies that will transform this sector.
Thank you so much, sir. Shanmugam sir, do you want to add something?
I think Sar has told everything actually. So one of the third, Sar has, also talked about Atmanirbhar Bharat, but we have not been Atmanirbhar in edible oil, and we have not been Atmanirbhar in edible oil, not today or yesterday. We have not been Atmanirbhar in edible oil for the last, let's say, about 20 years or so. And because our incomes have been increasing and people have been consuming more of edible oil, actually, there is a huge need for edible oil, and edible oil will continue to get imported until and otherwise we disrupt this phenomenon. And in order for a disruption to happen, compare the situation as I was told, 1 ton per hectare. If we move to 4 ton per hectare, it's simply phenomenal. But the only constraint is palm is a crop which yields better in a high rainfall zone, actually. And that may be one of the reasons, actually, Prime Minister has targeted Northeast, but unfortunately, Northeast doesn't have more of plain areas, basically. But obviously, I think Assam and other areas where there's too much of rain, the rice cultivation is happening. I think it's time for them to change it to, edible oil cultivation in those areas, actually, so that we get more of edible oil, actually. So, and then one of the third largest commodity imports after crude oil and gold, the largest commodity imports is edible oil, and we need to control that, actually. That is not to say that we need to control edible oil consumption. Our per capita consumption is about 13 or 14, 15 kgs. I'm sure, Dr. Ritambra, you know about it. Yes. And the global consumption is more than, 35 to 40 kgs, actually. And we need to go up in terms of our consumption of edible oil as well, at the same time tackling our production constraints. So there's a small addition to, Sir's views.
Yeah.
But what is important is we need to identify factors that discourage Indian oilseed growers.
Yeah.
We haven't done a serious exercise in identifying. We know the factors, but it has to be politically accepted. One significant factor which discourages Indian oilseed growers is that he doesn't get even the minimum support price more often than not. And why he doesn't get minimum support price more often than not? Because of excessive imports of low-priced oils. Therefore, we need to actually regulate edible oil imports in this country. We need to regulate. We need a system of regulation and regulate it in a way that it does not depress domestic oilseed prices. We have not done that And I'm very clear about that in my view. Therefore, there are ways. I think that this is a separate topic by itself, which can be debated for 2 hours. Anyway, sorry, go ahead.
No, it's okay, sir. Thank you so much, sir. I would just take last question, which is related to the capacity building exercise. And that's what is the role of regional extension education to make farmers proper traders? We know that they are skilled, but what about the capacity building? Can it come through the extension education? Number 2, why not central government make one portal for whole nation where the farmers can apply for training and then they can be given the knowledge regarding same thing from anywhere that can be imparted? And number 3, why not the commodity exchanges work with agricultural universities to make intelligence better?
Okay, I think I will leave it to Sir. I mean, who can, who had seen that from the top, how it is happening. And he's a neutral, opinion provider, because I was an insider in the exchange actually. So I'll leave it to Sir for his, best advice in terms of, what needs to be done.
Yeah.
No, there is without doubt we need this regional extension services to build capacity. My sense is very, very clearly, if you're talking about capacity building for generating market outlook, or what was that question? Capacity building for what? The first question.
Participating in markets, sir.
Yes.
Sorry?
Participation in markets. Participation in markets.
Farmers are participating in the market. They are participating in the market. They are participating in physical. What is an Indian farmer interested in? He is interested in cultivating, harvesting, selling, putting the money in his pocket, and he wants to go home. Correct? Therefore, even in the, let me put it very clearly, even in the United States, where a farmer has 1,000 or even 2,000 acres of land, we should realize farmers do not go to a commodity futures exchange to hedge their risk. But all the farmers, the very large farmer, 2,000 acres, he doesn't do anything. But he watches CBOT prices, Chicago Board of Trade prices. Then he negotiates with the elevator company to sell a soybean or corn or whatever. For the commodity exchanges certainly perform a very useful function of price discovery and price guidance, a forward price guidance. Don't expect a small Indian farmer to go to an exchange. He is not interested. He is interested in selling his harvested crop to put his money in his pocket, and he has to go home. And therefore, we have to encourage him to look at commodity exchange prices for his price guidance. And therefore, there are ticker boards, etc. All that is happening. But that is not enough, because the prices that are shown in the commodity exchanges or discovered in the commodity exchanges can also be volatile. It can change. And therefore, we need to slowly start teaching, training, educating farmer producer companies. You can't go to, there are 130 million farmers in India. So it best is to start working with farmer producer companies, talk to them, engage with them, train them, teach them about the market drivers, teach them how to look at the market dynamics, tell them about experience. There is a module for training. I have actually developed a module of what should be communicated to farmer producer companies when you educate them about market outlook. It is possible. We can take that forward. Yeah.
Sure, sir. Thank you so much. And I see that many questions are keeping flowing in. So I suggest the audience, I would take all these questions personally to both of them, and we can also respond through mails.
Sure, please
and
share.
With this, sir, I would like to thank both of you on behalf of my institute, my university, and myself. It's really been an honor to be with you here and listening to both of you. The talks were excellent. And I wish that this mutual cooperation for benefit of the society will continue in the future as well. Thank you so much, sir. Thank you. And the audience, please join us at 3 for session 4. We have Dr. Kushan Kurde and Dr. N.P. Singh in the afternoon session. Thank you, sir. Thank you so much.
God bless you all. All the best.
Thank you, Ritambra, and thank you, everyone. Thank you, sir.